Greetings! This is going to be yet another video that exposes how people in the establishment, talking heads on the media, are still complaining about how the Federal Reserve is going to cause hyperinflation or some other crisis, and how they really don't understand the forces at play, the technological component of the economy, and how the accelerating rate of change means the deflation resultant from technology is exponential. And they continue to make a number of other very flawed assumptions in their statements, most notably how the United States is the only country in the world, effectively, and as if the Federal Reserve is the only central bank that is printing money. This is obviously not true. What this particular video will expose is how someone who says the US dollar will lose reserve currency status, which it might, she's not wrong about that, but she is wrong about a number of her statements in which she acts as though the US Federal Reserve is the only central bank printing money, when in fact the US Federal Reserve is only printing about 25% of the total money being printed in the world, and the other 75% is by other central banks. The United States is not an outlier on this front. And a number of other statements of how these formal economists and Federal Reserve policy advisors just cannot grasp that this isn't the 1970s anymore. The economy is very different than the 1970s, and how interest rates will never be what they consider normal, quote unquote, which is a 3% federal funds rate. The Fed funds rate is going to be virtually zero forever, as it should be. This is the path to greater human prosperity. And I will rebut a number of statements also made by the guest in this particular segment, although she is right about one or two things, which I will flag as well. So we proceed.
Let's get some insight from former Fed advisor and insider Danielle DiMartino Booth, currently the CEO and chief strategist at Quill Intelligence. So Danielle, billionaire Stanley Druckenmiller, the CEO of Duquesne Family Office, is now joining those sounding the alarm, saying that the Fed's insistence on holding interest rates down and buying trillions in bonds, even though the economy is recovering and markets are thriving, could actually end up threatening the long-term health of the U.S. dollar. He says the Fed was correct in its initial response to the pandemic, but that it is now using emergency measures after the emergency has passed and is effectively underwriting the spending binge in Congress, and that this could dethrone the dollar in the next 15 years or so. So do you agree that the dollar is in danger of losing its status as the global reserve currency?
Well, I certainly think that if Federal Reserve officials aren't a little bit more honest with themselves. I mean, this is the time to take a good hard look in the mirror and understand that they're facilitating the monetization of debt. It might not be directly. The Fed's liabilities are not legal tender, but because they're keeping interest rates at artificially low levels, because they won't even pull back on mortgage-backed securities purchases, when you see home prices rising at a record pace, the evidence is abundant that the Fed should have long ago stepped away from these emergency type of policies, especially given the fact that they have allowed fiscal policy to exceed where its bounds should have been in terms of addressing the vestiges of the pandemic. So we are no longer in an emergency situation. And if the Fed is going to insist on being an ostrich and sticking its head in the sand while it's pumping out $120 billion per month of quantitative easing as if we were in a depression, then yes, I see every reason for China to continue playing its very long game with the intention of eventually unseating the US dollar. It was in the aftermath of World War I in Great Britain. The debts that had been run up were so unsustainable that British pound sterling started to weaken appreciably, and then World War II came along. That was the coup de grace. That was when the dollar rose. But it was a 100-year process, give or take, compared to where we are today, and it tends to be the typical life of a reserve currency.
Well,
Okay, we stop right there. Problem number one. The United States is not the only country that is printing money. The United States is only printing about 1/4 of the world's total. The European Central Bank, China, and Japan are printing the rest, the remaining 75%. So in terms of proportional printing, no, the United States is not doing anything aberrant. Even if the United States stopped all its quantitative easing, the world total would only fall by 25%. Problem number one. Problem number two is that $120 billion a month as though we're in a depression. No, the number is absolutely in line with what is needed to halt technological deflation. Now, this is a concept she has no awareness of, that there's accelerating exponential technological deflation in the economy, and that is why all this monetary creation is not causing inflation. And remember, quantitative easing did not start just with the COVID-19 crisis. It was going on for 10 years before that. It started in earnest in 2009. It just went a little bit higher relative to its trend line because of the coronavirus crisis. And in fact, the world has to do $400 billion a month just to halt technological deflation. Now, she is right about the fact that the United States might lose reserve currency status, and that is because the Federal Reserve QE that's being done is done through purchases of treasuries and mortgage-backed securities. And anyone who's read any of my publications knows that I'm very opposed to that, and how the only solution, the end game, all forces are pointing in this direction, is that the central banks of the world have to send cash directly to people. They have to print money and send cash directly to people. They cannot distort the mortgage market and the sovereign debt market any further. I have another video over here of how $17 trillion of bonds worldwide have negative interest rates. So on that point, she's right. So I give her maybe 1/3 correct, 2/3 incorrect in what she has said so far. But remember, she does not have a technology background, and she has a formal economics background, which by definition means such a person knows very little about the real economy, because the economics profession is extremely theoretical and really can't take practicalities or outside information into account in their model. Therefore, she doesn't understand the accelerating rate of change, and she does not understand the impact of technology on the economy. Many economists think they do understand these things, but they quite visibly do not, as we shall see from going further in this clip.
Danielle, to your point, history does tend to repeat itself, and man does have a habit of debasing currencies, and we are now seeing this trend of loss of confidence in the US dollar, and we're getting some data to back it up. And the IMF, the International Monetary Fund, recently reported that central banks around the world are reducing their US dollar reserves. During the fourth quarter of 2020, the share of US dollar reserves held by central banks fell to 59%. That is the lowest level in 25 years. So we're seeing this shift away from the dollar. Can it be reversed at this point?
Jay Powell, when he first started at the Federal Reserve, was probably the most rational and independent thinker since Paul Volcker was in the building. And he made an attempt at normalizing interest rates. He made an attempt at shrinking the balance sheets. And really the stock market and the corporate debt market, they both fell out of bed. So that's...
Okay, this is the big problem right here. Normalizing interest rates. There's a belief that the Fed funds rate has to be 3% and that is normal. And raising rates against all rational indication is seen as normal. They use the word normalizing. The 10-year US Treasury bond is only 1.7%, yet they want to raise the Fed funds rate to be 3%. That would create what is known as an inverted yield curve, where short-term debt has a higher interest rate than long-term debt. I will do other videos about this as well, of how the Fed funds rate has to remain zero forever and QE has to continue forever. And those of you who are familiar with my writings know this already and know why this is, but I think this has to be repeated just again and again for the rest of the world to finally learn about how the new economy is quite different than their 1970s era thought. Now, she is right about how buying of treasuries and mortgage-backed securities is distortive and how the balance sheet is itself a problem.
The problem with the Fed's policies and the fact that they insist on perpetuating this policy going forward is that they're inflating the bubble that is in risky asset prices more and more every day, with their refusal to even stop, look back and say, you know what, maybe the Treasury purchases are appropriate, but we certainly shouldn't be pumping up the housing market given the damage that's being done to those who cannot find affordable housing. And the Fed is in theory supposed to make monetary policy in the public interest. That's on their website. So it is time for some rationale to enter into the discussion, but I think Jay Powell is so traumatized from his attempt at normalizing monetary policy that he may just want to take the next 8 months and get out the door.
So, I mean, what does that mean? If you're saying Jay Powell may be in a position where he's given up, I mean, what does it mean for the dollar if there are, correct me if I'm wrong, I'm hearing you say that there aren't policies that could be implemented at this stage to turn this around?
It would be very difficult, because if the Fed was to try and normalize policy and the stock market was really to take a big downturn, then you would see that ripple through the economy, and we would be back in recession. So again, the magnitude of the Fed's intervention in this particular episode has put an entire economic recovery inside of a time compression chamber, all because it has been fueled by massive fiscal stimulus spending that is facilitated by the banker, by the Federal Reserve. But the Fed needs to understand that they've gone on a bridge too far, and they need to step back and become independent again from fiscal policy. Otherwise, the appearance that the Fed has effectively merged with the Treasury Department is going to continue to build, and the Fed's credibility is going to continue to be diminished.
Okay, that was interesting because she is partly right and partly wrong. Yes, there should not be a merger of monetary and fiscal policy because that rewards the government for very bad spending practices, huge deficits and things like that. But at the same time, she is completely incorrect about how the Federal Reserve has to normalize policy. It has to go backwards. Quantitative easing did not begin just with coronavirus. Let me switch over temporarily to the monthly balance sheet that we've looked at in other videos. You see here this monetary policy balance sheet worldwide. The red line is the US Federal Reserve, and the other three are three other major central banks. And the US is not the biggest money printer and only about 1/4 of the total. The United States has done 7.9 trillion since 2007, and a lot was going on before coronavirus. Now, if you see the grand total, the world has done 29.3 trillion, or just the four biggest central banks. Many smaller central banks are not even included here. And the US, as we saw, was 7.9 trillion out of this 29.3 trillion. So a little bit more than 1/4. That means even if the United States stopped, only 25% of world money printing would stop. And yes, this was done because of coronavirus, but it also broke this very misguided flattening that was happening in the world, because this trend has to be rising exponentially for reasons I explain at great length. Technology is becoming a greater and greater percentage of the world economy. This technology generates deflation. The amount of this deflation is very easy to quantify and easy to predict going forward. I have videos about that, and therefore monetary creation has to be done just to offset that. Now, back to the video.
Well, Danielle, the Fed's credibility has been diminished, many would argue. Here on Kitco News, we've had several of the brightest minds in business, economics, finance, echoing that sentiment. Nouriel Roubini, Robert Kiyosaki, Rick Rule, Jim Rogers, Ron Paul, they are all saying...
Okay, that list of names she just rattled off, those are all people who have predicted 100 of the last 0 bouts of hyperinflation. They have predicted inflation so many times that has never shown up because they are still in a 1970s era mindset of economics. All those people have been wrong, and I have videos deconstructing the flaws in their arguments as well, as you can see in this channel. So to continue.
That the end of the dollar is near. I'm not hearing you say that you think that can be reversed in any effective way anytime soon without causing tremendous havoc. So what happens? What happens if the dollar does lose its status as the global reserve currency?
Well, you know, look, we can continue down this very stealthy path to socialism and find out sooner than later. Or, you know, hopefully somebody comes into power at the Federal Reserve that is able to be a little bit more adult. We don't necessarily have to advocate as policymakers at the Fed. The Fed does not have to advocate for keeping zombie companies alive. There are some small measures that the Fed could take. The Fed could talk about tapering asset purchases. It would set off a correction in the financial markets, but the Fed could still say as much and at least signal to the global economy, to the global community, we understand the error of our ways. We understand we're in between a rock and a hard place. But if we let a massive bubble continue to inflate on our watch, then the collateral damage is going to be everywhere.
So does the Fed have the power to reinstate confidence in the US dollar and ostensibly bring it back from the brink of a decline?
This is all extremely theoretical at this point, given they're not even thinking about.
But assume they were. Assume, as you say, suddenly the Fed catches a wake up, implements some kind of action now that's going to displease the markets, certainly in the short term, if that's going to displease the Biden administration. Can the Fed claw back the dollar into a position of dominance again, or are we foregone?
I think foregone is a bit strong, and I think that's why Druckenmiller was quick to point out 15 years as opposed to saying the sky is falling, it's imminent. Because there are things that can be done to reverse course. We do have many allies around the world still. There is still a lot of damage that's been done to China's reputation on the global stage because of the pandemic, because of how long they knew about the existence of the pandemic without raising the warning flag for the rest of the world. So there are plenty of economies with the United States if we were to be able to get past the immediate consequences of any type of rationale being re-entered into the calculus of Fed monetary policy.
In the worst case scenario, though, Jenny,
Yet again, a belief that the U.S. Federal Reserve is the only country in the world that is printing money. We just saw that that is not the case. The United States is really only printing in proportion to its share of the world economy, and therefore 75% is not being printed by the United States. I repeat that yet again because it is truly stunning to me that someone who is a Fed advisor and in a high position and often in the media just would either not know that or pretend that that is not the case.
What would replace the dollar?
I can't see it being replaced by anything else but the yuan, which would explain why they're trying as aggressively and as rapidly as they are. They've just announced that if you go to check out on Ant, that you'll be able to choose digital yuan when you're in your shopping basket. So they are trying to roll out a digital currency of their own. They're not saying they're going to use it to displace the dollar, but they have a bigger propaganda machine than we do, and they're never going to come out and say anything that forthrightly.
Danielle, arguably the issue is that the Fed is sticking to these monetary policies to help back the fiscal stimulus policies, and it doesn't seem like the Biden administration wants to stop spending anytime soon, even in the wake of that very disappointing jobs report. Non-farm payrolls increasing by just 266,000 in April, well below the 1 million estimate, and growing complaints from businesses across the country that they can't find workers. And yet President Joe Biden is saying that the extended and expanded unemployment benefits are not the problem here. All right, so let's assume that some reason prevails and the unemployment benefits are not extended come September. We still have the Biden administration pushing very hard for the so-called infrastructure bill. All right, so Danielle, if you're watching this, it looks like we're going to have a situation where you'll have more money chasing fewer goods. Call that inflation, if you will. What does one do to protect one's portfolio in this current climate?
Well, it's very difficult because of the correlations, because of the co-movements in between different risky asset prices. When there are disruptions in markets, when you start to see major declines in the stock market, what have you. But there is something to be said for they don't call them precious metals for nothing. They don't call them everyday metals. They call them precious metals. And there will be something to be said for having a lot of hedge protection, even though it has not worked out in a world that is crazed with cryptocurrencies. Again, if we're talking about the end game and China becoming the reserve currency status holder in the world, then there's a lot to be said for gold, silver, platinum here in the years to come.
So that would be your recommendation at this point, that the best way to hedge, protect one's portfolio is to be overweight precious metals?
I think that being bold in precious metals right now, I am personally, so I'd be a hypocrite if I said otherwise.
All right. Well, Danielle, thank you so much for sharing those insights with us. We really...
Okay, I don't mean to bash this lady too much, but anyone who says investing in gold is a good idea, particularly to hedge inflation, really doesn't know anything about investing. Number one, there is not going to be high inflation. All these inflation mongers have predicted 100 of the last 0 bouts of hyperinflation. And the reason there is no inflation from exponentially rising world monetary creation is for the reasons I have often repeated technological deflation offsets it. But even if there were inflation, gold is not the right thing to be in. In an environment of high inflation, the things you want are real estate, because a mortgaged house, for example, is really just a leverage bet on inflation. Gold has not done well historically if you go back any lengthy period of time, 10, 50, 100 years. So we'll just look at that for a second. This chart is the price of gold over 100 years. And notice how the price of gold today is still lower than it was in 1980. That is 41 years. It is also lower than it was in 2011, 10 years. Had you invested in just a broad stock market index like the S&P 500 in 1980, you'd have made a huge amount of money over the period of time during which gold was flat. Gold is a terrible, terrible thing to have as an asset class because it is both volatile but does not go up, and I've explained on this channel why the macro trend for commodity prices is downwards. The first principles of technology and economics means that technology increases the supply of any commodity, and since technology is accelerating, this supply increasing mechanism has also accelerated. We saw this with crude oil, and we are starting to see this with gold and other precious metals. These are not things that your money should be in if you want to actually make money. This is why gold investors and precious metal enthusiasts never actually discuss their returns. Now, this is the 100-year chart, and if you overlaid the stock market, including dividends reinvested over this, there would really be no comparison. The stock market would be up 50x, 100x over a period during which gold has not risen at all. And if you just take the 10-year chart, remember, $30 trillion of world money printing has occurred in the last 10 years. And during this 10-year period, the price of gold is effectively the same as 10 years ago. $30 trillion did not move the price of gold upwards. Yet all these people say they're bold gold, or that they have to be in gold, and gold is what you should put your money in. That is so incredibly deficient from any semblance of looking at the actual data that is crazy. I'm going to do a specific video about how gold bugs never actually discuss investment returns because their attachment to gold is purely emotional and there is no quantitative assessment of it, nor do they understand inflation, nor do they understand commodity pricing or technology at all. So that was quite a rant, and this video is getting pretty long, so we shall conclude over here. If you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.